Wall Street thinks that Amazon is burning $220 billion on a massive AI gamble that's going to destroy their cash flow. But Wall Street's also flip-flopping back and forth on Amazon stock. Every earnings call, prices going up and down. It's like a roller coaster. So what exactly is going on with Amazon, and why is their stock fluctuating so much, given that they're not even building out their own LLM? In this video, we're going to take a look at why Amazon is actually poised to win the AI race despite not having their own LLM, and how they're playing both sides of the physical and digital economy. Since Amazon is over 4.4% of the S&P 500, even if you're holding like a QQQ index or some other ETFs, or you're already holding something like Google, Microsoft, and Meta, what happens with Amazon is very likely going to impact your portfolio. So let's look at the charts. AWS revenue didn't just grow lately, it has accelerated for the 5th consecutive quarter to $42.2 billion. That's $169 billion a year run rate. But bears will point out that despite AWS doing so well, this $220 billion CapEx expense is going to squeeze Amazon's margins. But this is classic Amazon. Don't forget what they did with warehouses and one-day delivery in the asset-light era of Silicon Valley in the 2000s. They are doing it again for AI via massive AI infrastructure build-out. In late July 2026, Amazon dropped their quarterly report, and within 48 hours, the mainstream analysts slashed their short-term profit targets over these rising component costs, but we still think that Amazon has a huge upside. If you follow our channel, you'll know that these AI build-out, we're going through every single tech company, and they're all facing the same pressures from increasing costs for components, GPUs, memory, all for these AI chips and processing power. So the winner of the AI race is going to be the company that actually owns the compute itself, and they're able to monetize it the most effectively. To understand how this is going to be Amazon and what their chances are of winning the AI race, we have to break down these 3 key trends hiding in Amazon's financials that make them totally unique. How does a cloud company protect its margins, like AWS, from these soaring GPU costs? And how are they going to increase margins and create new business opportunities via AI? Let's look at chart 1, because Amazon has developed their own custom silicon business, anchored by Trainium for AI training and Graviton for general cloud computing. This new business segment has already crossed over $25 billion in annual revenue. This is the first key to Amazon's success, because Amazon hates giving up margin when they can do it themselves. By deploying their own hardware units, Graviton and Trainium, Amazon cuts the cost for compute on their AWS and cloud servers by 30 to 50%. While competitors are paying peak prices for hardware components, Amazon is developing their own and hosting their own AI processing power in a vertically integrated supply chain. That is what they're spending their money on, and that is what Wall Street is most concerned with. Amazon increased their 2026 CapEx projection to $220 billion in a single year. Pundits called it blind overspending. But this is Amazon. This isn't their first time with a massive CapEx budget and going against Wall Street. AWS already has a contracted backlog of over $496 billion. And in a single quarter, they added $132 billion in future commitments. So do the math. Amazon isn't building data centers and building hardware speculatively. They are building out capacity for demand that is already locked in through 2028. So that brings us to Amazon's margins, the thing that Wall Street cares the most about. Despite massive infrastructure spend, AWS operating margins have expanded to 39%, more than that actually. How is it possible in this current economic situation with rising hardware costs that they're doing so well? Well, it's because AWS generates a high margin recurring software type cash flow, and they use that to subsidize the build out of all that hardware technology, that which in turn lowers the cost for them on the software and AWS side. But the most interesting part for Amazon is what they're doing on the retail Amazon.com side. What happens when you take the most advanced cloud infrastructure company on earth that is hosting your favorite games and every mobile app you can imagine, imagine, and you connect it directly to AI and millions of robots. This is the part that's really exciting for Amazon in the future. And we can already see it's going to be a big deal. Of all the tech giant companies, Amazon is unique because the majority of their workforce are not coders, they're physical laborers in Amazon warehouses and drivers. Amazon is going full tilt into AI with robotics. Look at these figures. Amazon's active warehouse robotics fleet has already reached over 1 million units. Every time Amazon deploys a new generation of robots to work in their warehouses and process workflows, such as Sequoia and Digit, the cost of fulfillment of a package drops by roughly 30 cents. But across billions of packages annually, that's a real cash savings for Amazon. And you can use that to recoup the massive capex expense. Wall Street views Amazon as two separate businesses. One is a cloud AWS software company, and the other one is the e-commerce retail side with trucks and warehouses and all that. But the truth is that these two are working together. AWS is the brains that hosts the AI models and processes and has all the compute. And the Amazon.com requires all these robots to act as the hands to actually get the work done across every state and countries all over the world. You have the brains and you have the hands together in one entity. Amazon is using cloud profits to fund robotics innovations and using robotics savings in their warehouses to fund their custom silicon and hardware R&D. It is a closed loop, vertically integrated moat, unlike any other tech company. And this is why Amazon doesn't need an LLM. Their business model doesn't require one. They can also contract Claude or GPT or Gemini for customer service and to do basic tasks. But the real money saver for AI is owning the actual hardware components, owning the data centers that they can then use in AWS, and then running their own robotics and AI on those servers for millions and millions of robots around the world. So if we're looking at how to position our portfolio for this, we don't want to look at just Amazon in isolation because their stock price moves with every new earnings announcements and Wall Street is flip-flopping back and forth. We have to look at the actual supply chains and what robotics companies are poised for a long-term contracts with Amazon. So here's our playbook of two different scenarios that we can use to take advantage of this, how Amazon is going to succeed in the future. The first one is full integration, go directly with who Amazon is contracting. So Amazon is spending billions of dollars every single year on building out all this equipment and hardware. We're going to go look directly at their supply chain to see where they're buying from. First company is called Symbotic Inc, ticker SYM. They are an AI-powered supply chain systems and warehouse automation company. They're the ones who are going to be processing a lot of the robot tasks that Amazon requires. Another one is Cognex Corporation, ticker CGNX. They are a company that produces the sensors and kind of the eyes of different types of robots that will be used in Amazon facilities. And a third one is ZBRA Technologies, ticker ZBRA. They are an enterprise mobile computing and real-time asset tracking hardware company. They are basically when you roll out a bunch of robots and you have releasing this technology into different markets, they will actually help you track and catalog and inventory all those robots. Scenario 2 is broad diversified index exposure to the hardware itself. We know that all these big tech companies are paying more and more for components, memory, GPUs, etc. And all of these robots that Amazon's going to be using also require hardware components. And for anything that Amazon can't produce in-house, they will have to pay market price for. So we're looking at broad thematic ETFs that are going to diversify this risk. And one is Global X Robotics and AI ETF, ticker BOTZ. They capture a lot of heavy exposure to industrial robotics, not just for Amazon, but other companies. And they're also exposed to chip designing and automated systems to help the companies actually implement them. Another ETF is called ROBO Global Robotics and Automation, ticker ROBO. And they kind of focus on companies that provide a bunch of services for robotics in particular: healthcare robotics, logistics, transportation, sensors, anything like that. This basket approach balances long-term cloud growth against the hardware suppliers holding pricing power today, protecting your portfolio from a lot of volatility on the big tech, big AI company side by looking at the supply chains of the companies that are going to be picking up a lot of revenue from those massive CapEx budgets. While Amazon has secured its future for growth across AWS and Amazon.com retailing, there's another non-AI LLM company among the big Magnificent Seven that is also doing extremely well. And their playbook is completely different from Amazon's. So we're going to look at Apple, who's up over 30% on the last 12 months, while Microsoft is down over 4.8% over the same period. So we're going to look into what is making Apple a success on Wall Street in the AI era, despite not having their own LLM and not investing in data centers.